Credit Suisse collapse mean a repeat of 2008 all over again? As bad as the 2008 crisis was, the cure could be worse. After Lehman Brothers fell and the U.S. government stepped in to rescue finance from its worst instincts, many demanded that banking become, boring again. Storied lending, it was argued was what banking should be all about. Absolutely 100%. What about the gold standard? Credit Suisse has faced money laundering charges and a huge data leak this year. The CEO of the troubled Swiss bank attempted to soothe nerves, but default risk remains. That's a fact. Some are saying Credit Suisse is in deep trouble, and others are saying this is not a Lehman Brothers moment. But overall, from talking to IE bankers and looking at the data, they are in deep trouble big time. There are plenty of rumors, especially on Twitter. All those bots now. Elon Musk is going to go through the deal. 80% of Twitter is all bots. I can speak to that. It's goofy. So, they're saying on Twitter, Credit Suisse, CS on the NASDAQ is on the verge of collapse and the financial system's on the brink of European Lehman Brothers moment. I wouldn't foul just Twitter, but let's look at the facts. The major international investment bank that is on the brink, and that's according to ABC Australia, is Credit Suisse, they stated. So let's take the position that they're going to go under in the next month. They got a meeting coming up end of, I think, October 27th. So on paper, this does not look good. When you look at this on paper, it's not good. They had exposure to two implosions, that cost Credit Suisse billions and put the bank on very unsure footing heading into the Q1 of 2022. The consensus belief on Wall Street is that the potential Credit Suisse insolvency event would undoubtedly hurt the entire financial system. Well, absolutely 100%. It doesn't take a genius, and you're making $1 million a year as a fund manager. Come on. So the 2022 bear market has drawn a lot of comparisons to the 2008 financial crisis. That's mostly because it's the most recent normal recession. So the COVID-19 crash, that doesn't count at all. So obviously, that's a weird comparison, to say the least. But astute investors have noted that the 2008 crash was exacerbated by the bankruptcy of Lehman Brothers 100%. It was, as we all remember from the movie, it was a black swan event that very few saw coming, and it sparked a financial contagion that spread across the equity markets, sending, the S&P down roughly about 40% in just 2 months. So, we haven't seen that black swan event in 2022 yet, and so most investors have written off a 2008 comparison as overly, pessimistic right now. But the fact is, all that changed this past weekend. And, I came across some interesting international stories, and I talked to some investment bankers. And, on Sunday, ABC Australia reported that a major international investment bank is on the brink, citing a credible inside whistleblower source. And everyone on Wall Street knows who they're talking about, and on K Street. It's no secret. So who are they talking about? Come on. Will the bank eventually blow up like Lehman Brothers? Will it blow up, spark a broader financial contagion that crashes, the stock market by 40%? Who blew up that pipeline? Europe's in deep trouble. Was it done by design? So how should you be positioning your portfolio right now? What's going on globally? You better think between the lines. I sure am, and I moved a lot of stuff out of certain sectors. So which bank is on the brink? CS. The major investment bank that is on the brink, and that's according to ABC Australia, is Credit Suisse. They try to, cover it up a little bit. So, the bottom line is Credit Suisse has been struggling for about over a year now. The bank has had significant exposure to a highly leveraged hedge fund that blew up in epic fashion mid-2021. It's also had major exposure to Greensill. It's fintech disruptor that, they wanted to make financing fair, which itself imploded in, March 2021. So those two crises, guess what, folks? They cost Credit Suisse billions and put the bank on very unsecured footing heading into the first quarter of Q1 2022. So, as you all remember, then the bond markets, they went crazy across North America and Europe this year. Government bond yields have soared in a way that they've never soared before. And, it's problematic because it has injected unprecedented volatility into the traditionally stable government bond markets. And banks like Credit Suisse count on traditionally stable markets to stay balanced. They've been taking some risk. So when they, get hit with long-lasting, unprecedented volatility, bank trading models tend to break. It's all priced in, as my buddy would say, and he was a good banker, but not this time. A well-capitalized bank can handle those breaks, but a struggling bank, and Credit Suisse went into 2002 struggling. They cannot. Credit Suisse was deeply damaged coming into 2022. I can't emphasize that enough. And apparently it is now struggling to just stay above water from what I'm hearing. And they're trying to kind of cover it up. So what CS is exposed to material credit risk due to, the macroeconomic backdrop. These exposures are not outsized in the context of its strong capital and liquidity positions, some people are saying. So, why is the stock imploding and CDS premiums rising? That's a question. So, from the research, talking to some people, it all has to do with the investment bank, IB. The IB is in a tailspin due to persistent risk management lapses. The debacle in 2021, the hedge fund lost $5.1 billion. Litigation cost, high cost of funds, the departure of the key staff, the key guys and gals left, and a business model that is significantly disadvantaged by the current macroeconomic environment. In recent quarters, it really just couldn't catch a break. So, it's not good from looking at the research, and CS right now has no choice but to fundamentally restructure the IB, and the market is smelling blood. Internally, they all know what kind of trouble they're in and what they're trying to do. Sounds like the movie The Margin Call. The problem is that restructuring an investment bank is a long, arduous, risky, and it's a costly exercise. It can't be done in a short period of time. CS will likely need to raise capital, set up a non-core bank that will bleed losses for many years to come, and it will lose key staff to competitors. There is no easy way of achieving this, and especially so in the current bear market right now. Raising capital right now. If you follow this stuff, all the people pulling the book, pulling this out now at the current market validation is highly problematic, and it may need to sell some of its crown jewels right now. There are no real good options now, just less probably bad ones. And finally, CS is caught in a vicious cycle similar to Deutsche Bank in 2018, if you all remember that, where high funding costs adversely impacted profitability, which in turn feeds into even higher funding costs. Getting out of this, the tailspin is going to require both skill and not a small amount of luck. They're going to need a lot of luck. The bank's credit default swap spreads have just hit their highest levels since the depths of 2008 financial crisis. That means that the market believes the odds of Credit Suisse going bankrupt today are as high as they were back in late 2008. I hate to say it. That's what I'm hearing and reading. So when investors go through entire global financial systems, was going to collapse. So the bottom line, in my opinion, while the odds of a Credit Suisse insolvency event are still below 50%, and even some say below 30, but it's closer to 50 in my opinion, the odds are higher enough for you to factor this risk into your investment decision-making calculus, ladies and gentlemen. So Will a Credit Suisse collapse crash the markets? Holistically, look at Lehman Brothers. What happened? That was the black swan event. You know, the weirdest thing about this potential insolvency of a major investment bank is that nobody really knows what, you know, will happen afterward. That's true. We have some precedent. So, and there's been some more checks and balances put in since 2008, but the investment banking and financial derivatives world is a giant black box. We don't really know what these banks are doing behind the scenes with all their risks, and that was the problem in 2008. Yes, and these, you know, seemingly unrelated banks were holding each other's risk. So when one blew up, almost all of them did. They're all intertwined if you read into this stuff and know what's going on. That could still happen today, but less unlikely. Since 2008, a series of legal measures, as I discussed, have been put in place. I talked about this a while back, especially in the U.S. to restrict the risk of financial, you know, contagion spreading throughout the entire banking system. That's why the Fed, you know, they say they regularly run stress tests on all the major U.S. banks. Look how they've been spending like drunken sailors and printing money, and money's going out the back door. That's what concerns me. The banks have consistently, you know, they pass those tests from the Fed on the surface. What concerns me, what's going on under the surface. That's because, you know, they are much better probably capitalized today. They have much less systemic risk exposure and better risk management practices than they did in 2008. So, therefore, you know, the consensus belief on Wall Street is that a potential Credit Suisse insolvency event would undoubtedly hurt the entire financial system, but it wouldn't put everyone else on the brink too. There's some truth in that from the research based on some of the checks and balances if they're following those. That's why most Wall Street banks have seen their stocks decline only 25% to 35% in 2022 versus 60% plus meltdown in Credit Suisse stock, and that's a good sign. So you're seeing that separation. The bottom line, CS is in big trouble and should have no doubt, you know, and there's no doubt about it. I suspect they will need to bring forward the announcement of their restructure and currently scheduled October 27th or 28th. Probably they're going to bring it much earlier, maybe even this week. This could be a fire sale. That's a possibility. However, this is not solvency, liquidity, or a systemic risk event. This is not European Lehman Brothers moment overall. Still, while potential repeat of 2008 likely isn't on the table, but it is on the edge of the table, in my opinion. A potential deeper drop in stocks is definitely on the table, folks. 100%. God, I love real estate. I love it. Talking to my e-banker friends, they got their hands in their faces. In anticipation of that drop, you need to position your portfolio for success. That means that over the next few months, just saying, you know, the stock market is going to drop another 5% to 10%, probably, in my opinion. Earnings season will disappoint. It's not looking good. 2023 earning estimates will be revised, probably lower. Validations will be reset to those lower earnings estimates for sure, and financial stress in the system will continue to build 100%. So, you know, concurrent to the market sell-off, we, you know, from what I'm hearing from my guys, we expect, you know, higher quality, higher growth stocks to soar in late 2022, early 2003, just like they did in late 2008 and 2009. You know, but it's not going to be, and I bought some Amazon during this pandemic, and I bought Netflix and Salesforce, but it's not going to be those stocks leading the rally. I think it's going to be the next Amazon. It's going to be the next Netflix, the next Salesforce that you want to look for, in my opinion. So to kind of put a bow on it, there are some checks and balances, but the Fed is so unpredictable. We have the Fed chair saying things are transitory when they're not. We have Janet Yellen coming out saying, I basically lied because she got political and went to the White House. You don't play games with people's money. $9 trillion has been lost in the markets since Joe Biden took office. But so the Fed put in these checks and balances in 2008. They say they stress test these banks, but I just don't believe them. So on the surface, it looks good that there won't be a black swan event like Lehman Brothers. And from the data and looking at the models and talking to investment bankers, and I'm very close with some of the best, you're not seeing the drop in these other companies, that the banks are not as intertwined. So worst case black swan event, Credit Suisse does crash. It's a major event, but the other banks will be protected. But if you looked at the stories, they were trying to say, don't worry about it. It's not, nothing's wrong with Credit Suisse, but there is something wrong with Credit Suisse. They're in big trouble right now. That's all I'm making you aware of. And from the data points of everything the Fed is saying, and from what IE bankers are saying, it won't be a black swan event, but it's closer to 50% that they might go insolvent. And we'll see what happens if they give their talk earlier than later. That's going to be a big sign if they give their talk earlier than later. So something to be aware of. Finance is something we cover. We're passionate about. We went to school for finance. We talk about finance. I'm 40% in the market, and other people that I work with that work in investment banking that I get information from are very knowledgeable in this sector. And it's very concerning what's going on with the banking, and then now what's going on with the global markets and all the money we're taking and giving to Ukraine, and all the global chess game going on right now is not helping the markets, and the inflation is just killing everybody. And it's just one thing after another every day. They want to keep you on your toes. They don't want you relaxed. So you got to try to stay ahead of it. So we'll see what happens with Credit Suisse. Take care.